Hello, welcome back. All right, up to this point in the Value of Growth lecture series, I focused almost exclusively on enterprise value as our measure of overall value, total corporate value. In Wall Street and most investment funds, they tend to think about price and price to earnings ratios. So what I want to do today is use these same tools that we've been developing to talk about how they translate into the world of PEs, price to earnings ratios, and show you that the map is actually pretty easy and pretty straightforward. And I'm hoping for those that live in the PE world, which probably is most of you, you'll see benefit in taking my tools into the PE world. At least I hope so. That's the goal of this lecture. All right, let's get started. All right, so I'm going to use PEs as my primary driver of value, if you will. Now, I think any experienced investor will tell you that PE is kind of almost in a sense, a residual measure, not a primary measure. What do I mean by that? Residual in that you determine PEs by taking the price of a stock and dividing it by earnings. Now, you could use historical earnings, you could use forecast earnings, you could use earnings a couple of years out. Some people do for growth companies. They'll say earnings in 3 years will be X. So the PE on those future earnings today is Y. That's certainly an application a lot of people use. But what I want to do is think about the idea of inverting that a bit. Let's say if we could determine price as a function of the PE times an earnings or earnings estimate. Now, I don't think that PEs are constant that way. And I think that sometimes investors get in trouble assuming a PE, forecasting earnings, and then using that estimated PE and those future earnings to determine a future price. It's not bad, but unless one really understands the drivers behind PEs, I think that that is potentially dangerous because if you get the PE wrong, even if you're clairvoyant on the earnings, you have a great earnings forecast, you're going to be wrong on the stock price. So what I want to do today is use the tools that we've developed so far to really see if we can get some insight into PEs and what drives PEs. All right, so let's start. All right, in the PE world, we're going to think about not the private equity world, but in the price to earnings world, how would stock prices go up over time? And this lecture series is really focused on the long side of investing. And yes, there's opportunities on the short side. And maybe in the future video, I'll talk a bit about it. But I really want to focus on the long side of investing. So here's a simple question. How do stocks go up over time using PE as your primary tool? And if we're long a stock, we want it to go up. All right, so there are 4 ways that stocks can go up in this framework. One is you grow NOPAT, grow your earnings with a constant PE. And there are a lot of investors that really focus on that. There is some assumption that the PE will stay constant over time. I'm going to really talk about that in this video. And then what they do is they're capturing that earnings growth. Because if the PE stays constant, PE times a growing earnings, the stock price will track those earnings. Okay. All right. Second is earnings can grow and you can increase the PE ratio. Now, obviously, that's even better because you have the growth of the earnings and you have an expanding PE ratio. Obviously, price will actually grow faster than earnings. Next one is you can have the NOPAT stay constant over time while the PE ratio expands, increases. That's somewhat more rare, and it's probably related more to interest rates than it is to fundamentals, the fundamentals of the company. And then the final one is you can increase the PE ratio significantly to offset a decline in NOPAT. So those are the 4 ways you could do it. The first one's probably the most common, then the next one, then the next one, the final one. So we grow earnings and have a constant PE, grow earnings, have an increasing PE. That's going to be the most common situation. Now, there are cases where you don't grow NOPAT, but PE expands. That's kind of a special case. And then fairly rare would be you increase the PE ratio to offset the decline in NOPAT or earnings. And in that case, it would be, I think investors are very excited about a new launch, a new initiative, a new investment, a new product launch or something where earnings are going to go down in the intermediate period as that new product is brought to market or that new investment is made. But investors are very excited about its potential, so they're willing to pay more for current earnings, enough to offset that decline. All right, so here's a little matrix you can have. Green, stock goes up, red, stock goes down, and then yellow, it's kind of neutral. I'll walk you through it. So at the top left corner, you grow NOPAT and you expand your PE. Obviously, your stock's going to go up. Grow NOPAT, constant PE, stock will still go up. Go down the first column, NOPAT stays constant, but you expand your PE, stock price goes up. And then the last one we just talked about. So those are the four mapped. And it's easy to see that if NOPAT stays constant, but your PE contracts, it goes down, then the stock will go down. And if NOPAT declines, earnings decline, even if the PE stays constant, stocks will go down. And if you often see when earnings decline, your PE contracts and the stock obviously goes down even more. The two neutral ones are NOPAT stays constant, PE stays constant. Well, stock probably shouldn't do anything. And the other one is that you grow NOPAT, but you contract your PE, and we'll talk a little bit about that, kind of neutral, hard to tell. All right, so let's walk through each of these, really talk about the source of these movements. All right, so the first one we talked about is grow NOPAT earnings with a constant PE. So it, I hope, begs the question, why do PE ratios stay constant over time? Now, here's the key insight is that PEs will stay constant if expectations for NOPAT growth in the future and the incremental return on capital holds. If those two things hold, your PE will stay constant. Another way of saying it is if you believe that PE is going to stay constant, then you effectively believe that the NOPAT growth opportunity will stay constant. It will not decline over time. And the incremental return on capital will hold, meaning that the quality of the business will hold. Incremental investments will be at the same level of profitability, same level of return as is current in the business. So this, I think, is a really important insight. And since growing NOPAT earnings with a constant PE is the most common long-term investment strategy, delving on this for a second is probably worth it. So for PEs to stay constant, this is the requirement. Future growth rate, the rate of growth has to stay constant. It can't decline. If it goes up, we'll talk about that. And the incremental return on capital as the company grows stays basically in line with the historical trend. The business stays the same. And if that's the case, each year the stock will go up. All right, that's our first case. All right, next one is changes really in PE, right? We grow NOPAT grow NOPAT and increase the PE. So we have to ask kind of the question of why do PE ratios expand? The second one is you keep NOPAT constant while the PE expands. And the third one is you increase the PE to offset a decline in NOPAT. So all three of these are an expansion of the PE. The first one was a constant PE. The next three are expansion of PE. So then that begs the question, why do PE ratios increase over time? Well, it mirrors that. It's really three possibilities. It's two and a combination of the two, but three. So expectations for future NOPAT growth increase while you hold the incremental returns constant. So the growth rate's accelerating and the quality of the business is remaining the same. So the company has found a way to increase their growth rate while holding the quality of the business measured by the incremental return on invested capital. The return on capital for that growth is going to effectively stay in line with the historical returns. So that was, in those cases, PEs expand, which I think is really kind of a cool insight. Now, the other thing is that you're going to have expectations for NOPAT growth to hold, in that the growth is going to continue, the historical growth rate, while the incremental return on invested capital increases. The business is getting better. As Buffett would say, the moat is expanding. So my growth rate stays the same, but that incremental business is getting better. You can think of a scale business as they're growing, but as they get bigger, their return on capital is increasing. The incremental return on capital is higher than the current return on capital. So if either of those, one, we either increase the growth rate of NOPAT while the return on capital, incremental return on capital remains the same, or you the growth rate holds, but the quality of the business is improving. Either of those cases, the P will actually expand. Or you can have both, of course. Growth rate increases and the incremental return goes up, but then your P is going to expand even more. All right, so we've been able to build kind of, I think, a straightforward framework to think about. All right, so now if your incremental return on capital is going to go up, there's a couple implications. So if the incremental return on invested capital is going up, then either NOPAT margins, profitability, is increasing, it's going up, or the amount of capital you need incrementally per dollar of investment, per dollar of earnings is going down, right? So either the profitability is going up and the capital's holding, and therefore the company's becoming more profitable on the same base of capital, the incremental capital is becoming more profitable, or your invested capital is going down for an increase in a dollar of earnings. So either your profitability is increasing for the level of capital, or the amount of capital you need to grow those earnings is going down incrementally. All right, if NOPAT margins are growing faster, they're increasing, that means NOPAT and your earnings power value are growing faster than revenue. The business is getting better. Business is getting more profitable. And if invested capital is going down incrementally, then the business will generate additional excess capital as it grows. There'll be more capital it throws off as it grows. So these are just important implications. If you're making the argument that the incremental invested capital for the business is going to get better, it really has to be driven by incrementally more profitable growth, or you have less capital intensity as you grow, more capital efficiency as you grow. And if NOPAT margins are increasing, the margins themselves, that means that NOPAT's growing faster than revenue, which is important. Investors like that, obviously. It's not sustainable forever, but that certainly increases valuation. Or it's possible that incrementally the company does not have to invest as much money to generate incremental growth in earnings, which is usually from scale, some form of scale. All right, we've talked about this a couple of times on videos. This is our valuation challenge. This is your future NOPAT. Traditionally, we use the DCF for this valuation challenge. The problem, of course, is that growth really causes enormous headaches for DCFs. In fact, I would argue that's what really breaks DCFs, or the growth rate, particularly as it gets a little bit higher. And the duration of the growth rate really messes with it. So I argue, let's just separate it, the valuation challenge, into two problems. One, that NOPAT, which is effectively your earnings power value, and then green, which is the growth, that value of that future growth. All right. Now we know earnings power value is easy to calculate. So because it's so easy, it's worth doing. Separate the problem into two. Why not? Earnings power value is trivial to calculate, and then the burden of the valuation challenge is on market-implied value growth, that future growth. We're going to use this tool in the PE world momentarily. And this is hard to calculate. But I want to show you the implications for people that invest using PEs as their primary valuation metric. All right, so that's the challenge we're looking for, right? Enterprise value increases over time. That's what we're looking for. How has that happened? And so we can now go back to our four cases. So there are four cases, right? Earnings power value goes up and your market implied value of growth goes up. If they both increase, obviously the combination of the two will increase. Now, I want to pause for a second and just point out something that's really important. On the left, earnings power value, just as a reminder, that's driven by your earnings power. We're capitalizing your earnings power. Management should have significant influence on growing their earnings power value over time. That's strategy, that's execution, that's discipline, all of that. So they should have significant influence on blue, particularly blue over time. Green is, by definition, market implied value of growth. This is what investors are willing to pay for when they assess future growth for the company. So on the left is kind of driven by management, I think, and on the right is really driven by investor perception. And yet, you know what we do? We do compensate management on both. We don't teach them that there are two pieces. We don't explain to them that the green part is driven more by investors than by management. Now, true, management can influence green for sure, but because very few managers have figured out that the blue piece is what they control and the green piece is what they hope to influence, then there is this disconnect for most senior managers between their stock price and their operation. And that's because green can move around. We're going to talk a lot more about green over the next couple of videos, but I just want to introduce this. All right, so back to our case. If earnings power value is increasing and green is increasing, obviously when we add them together, the total's increasing, and that looks like that. Both are increasing. All right, the second case we had is your earnings power value goes up, but your market implied value growth stays steady or flat or constant. This is effectively a constant PE. I should probably say on this one, this is a expanding PE. The PE is actually increasing, which we're back to the PE world. This case, earnings power value, earnings are growing every year, but what investors are willing to pay for future growth is staying constant. Now, if we add a growing series, earnings power value, to a constant series, market implied value growth, the total will also increase, and it looks like that, right? We do see that increase. All right. Third case we talked about, this is effectively a PE expanding on flat earnings, unusual, probably driven more by rates than by anything else, rates coming down, is your earnings power value is flat, but your market implied value of growth increases. This is effectively an expanding PE. And so your market implied value of growth is the source of all of your price appreciation, stock price appreciation. So investors are getting more excited about the future growth prospects for the company. Interesting, even though earnings are flat. I'm going to do a case study on Apple in a couple of weeks, and this is Apple, frankly. The stock went up mostly because green went up, not because of blue. All right, but that still increases the stock price. All right, and then here was the last case, which was earnings power value is coming down, but your market implied value growth is going up more than the decline in your earnings power value. So you're seeing expanding when they get added together, that's expanding. Somewhat unusual, because if earnings are coming down, usually investors will be more concerned about the growth prospect, not more excited about it. However, management is telegraphing that they're making a significant investment. They have a lot of credibility. Investors are excited about what will happen once the investment it starts to bear fruit. It is possible for your market implied value of growth, that green section, to go up more than earnings power goes down. All right, and that's what that looks like combined. All right, so we can map this back to earnings power. We originally started with NOPAT and PEs, and what you see is it maps perfectly to earnings power value, and which is a function of your earnings power, your NOPAT, and market implied value growth. So market implied value growth translates to your PE effectively. It's the excess PE, which we talked about in the last video. And we see the same four cases, right? If PV grows and your market implied value increases, the stock goes up. On the other hand, if your EPV declines and your market implied value growth decreases, then the stock will go down. So market implied value growth is a direct proxy to that excess PE, the PE above your cost of capital, which is pretty cool. So there it is. So the first equation is your earnings power value plus your market implied value growth. So PE is effectively a function of those two. And for investors that believe that the PE is going to expand, you're effectively saying that the market implied value of growth is expanding. Investors are more excited about the future, and that's going to be driven by higher NOPAT growth and or an increase in incremental return on capital. All right, so I think we mapped PEs back to the lecture series so far. I'm pretty excited about this because when you talk PEs, you now can map those to things that are very, I think, analytical. You can go back and look at those pieces. So this to me is kind of a cool breakthrough. All right, now, in the world of value investing, you'll often hear book value as a measure of value, frankly, and you'll hear price to book. Certainly, if you look at the historical discussion around value investing, book value is talked about a lot. And it is part of really the value investing canon, the history, if you will. Both Ben Graham, and Roger Murray use the metric fair amount in their lectures, and they're the two. I mean, Graham's really the father, and Murray's sort of the uncle of value investing. And then Bruce Greenwald from Columbia Business School, who I think a huge contribution to value investing, which I'm going to talk a lot next in our next series of lectures, devotes a whole chapter in his book, Value Investing from Graham to Buffett and Beyond, which has been a wildly successful book on value investing. So, book value, I've never talked about book value up to this point. And after this part of the lecture, you'll never hear me talk about book value again because I want to explain why I think, frankly, they were wrong. All right. Now, first off, remember there's a big difference between book value and liquidation value. I've heard people say over the years, well, book value is safe because that's what I get if I liquidated the business. And it's just not true. Absolutely not true. Now, there are going to be some rare occasions, maybe with a lot of land that is on the books well below its value. But short of something like that, your liquidation value is going to be substantially lower than your historical book value. Almost always. Just liquidating is going to be a discount, and you can go through all the accounts and realize that in a liquidation, they're not going to hold their value. So I would be careful about thinking book value as a liquidation value. It's just not. Some rare cases, the liquidation value is going to be greater than the book value, but in almost all cases, the liquidation value is substantially lower than the book value. So be careful about that. So here's my comment. I think they were wrong. I think Graham was wrong. I think Murray was wrong. And I think Bruce was wrong. All brilliant men. All brilliant contributors to the investing knowledge. No question. I should probably do a little lecture on the history of all this at some point. It's kind of fun. But they were wrong. They were wrong. And let me show you why. All right. So book value based on historical accounting. Now, we've had very little inflation up to the recent bout of inflation. So we didn't have inflation as a problem for the historical accounting. It was pretty good. So book value based on historical accounting is a reasonable proxy for invested capital. Not perfect, and there's going to be lots of exceptions, but not bad. It's not a bad proxy. So in a competitive market, meaning there are no barriers to entry, firms are competing, each company should earn a return on capital equal to its cost of capital, right? That's where you're going to have that kind of equilibrium in a competitive market. So ROIC equals roughly the cost of capital, which means that we can disaggregate ROIC. That's your NOPAT divided by the invested capital should equal your cost of capital. All right. So now if we capitalize NOPAT using a perpetuity valuation formula, that's our earnings power value. That's the definition of the earnings power value. All right. So now if we play with the two equations, we can show you that, guess what? If NOPAT divided by invested capital, that's your return on capital, should approximately equal the cost of capital in a competitive market. And then we replace that with, rearrange the equation. We get, guess what? NOPAT divided by R, which is your capitalized NOPAT, earnings power value, should approximately equal invested capital. So it's taking the next step, then one could argue price to book effectively is your market cap to your earnings power value. It's the market capitalization, the equity market capitalization to your earnings power value. That's, I think, pretty straightforward. Not perfect. That's why I use approximately equal, but it's pretty close. Therefore, a low price to book is nothing more than a low price to earnings power value, with the difference between your market cap and your earnings power value, effectively your market-implied value of growth, which we've been talking about. In this case, which will be low, zero, or maybe even negative. So a low price to book is effectively a low market-implied value of growth. How do we say that more directly? Low price to book means investors are paying very little for growth, or maybe nothing for growth. I think that's the key insight. It's not price to book that matters. It's the low market-implied value of growth. Now, I'm going to say this a million times in this lecture series. It's the market-implied value of NOPAT growth, earnings growth. So if you go back and you think about situations where you're going to have a low price to book or price below book, effectively investors are saying the cash flow from the business is not sustainable. It's not, there's no growth opportunity there. In growth in earnings power value. But in a lot of the historical price to book situations, there was the belief that the situation was temporary. There was some impact on the business that wasn't going to last. And there's some talk of reversion to the mean at times and things like that. All of that means that investors are underestimating the company's ability to increase its future profitability. And if it increases its future profitability, it's going to grow its NOPAT. By definition, its earning power is going to go up. So a historical, Graham, Murray, Greenwald, when they're talking about low price to book, they're effectively saying that investors are unwilling to pay for future NOPAT growth, which may be appropriate. But if you're betting that that low price to book is incorrect, creating a investment opportunity, you're betting, you believe you have an analytical advantage, you're betting that NOPAT will grow in the future, which could be revenue growth, but it may just be improvement in margin. And so I think it is a much better way to think of low price to book as low price to earnings power value. And you're betting, if you're placing that bet, if you're making that investment, you're betting that earnings power value is going to increase in the future. And it means you're going to grow NOPAT. And you're going to grow NOPAT through margin expansion, which may be nothing more than reversion to the mean on profitability. Or guess what? New management team or a new focus, we're going to get this company back on its way. So I just don't think price to book was correct. I think it was really market cap to earnings power value, effectively not paying for growth and not believing that there was the opportunity for the company to improve its NOPAT profitability in the future. And so I think that is a much better way of thinking about it. I'm not a big fan of price to book. It's never made sense to me. And I think because it's really driven by the cash flows. Everything's driven by the cash flows of the business. And a low price to book means investors are basically concerned about the company's ability to grow its profitability in the future. A bet on a low price to book stock is a bet that management will be able to improve its profitability, grow its NOPAT. Maybe you don't pay a lot for growth in the future, but just improving those earnings will drive the stock price higher. So just wanted to throw that in at the end of this lecture. All right. Thank you very much for watching. See you in the next video.